The footprint basically serves two different purposes. We can use it to identify support and resistance levels in different ways, and we can use it to validate any other type of support and resistance we find in a candlestick chart. Let's begin with the ways of identifying support and resistance levels with the footprint itself. There are mainly two ways of using the footprint to identify support and resistance levels: consecutive high volume nodes and stacked imbalances. Let's see an example of both. Single high volume nodes are usually not strong enough to provide meaningful support and resistance levels. But when high volume nodes happen consecutively in the same price level, there is a higher chance that they will act as support or resistance. In this image, you can see an example of that. We can see three different price levels with multiple high volume nodes. The first has 2, the second has 3, and the third has 2. We see price returning to this high volume area later and then resuming the movement to the upside. In this other image, you can see an example of stacked imbalances working as support. The low of the large bearish candlestick is formed by 4 stacked imbalances in the ask column, denoting buying aggression near the low. When price returns to that area later, it reacts to the upside. These are the two main ways of observing support and resistance levels with the footprint, but in my point of view, the best value we can get from the footprint is using it to confirm support and resistance levels we would normally find in a candlestick chart. This requires a contextual reading of the footprint chart in light of the support or resistance level in question. Before we observe examples of that, we need to be aware of two important aspects of the footprint: the price imbalance relationship and the price delta relationship. Price imbalance relationship is observing the position of the closing price of a candlestick in relation to the bid and ask imbalances that occur in the footprint. This is important to identify potential absorption or initiative of market players, which are important features of market reversals. Let's observe the absorption pattern. If you see price closing below an ask imbalance, the interpretation is that buyers are being absorbed by sellers. Since an ask imbalance generally means buying aggression, price action should confirm that by closing above it. When it doesn't, we can infer that sellers are absorbing the buyers. If you see price closing above a bid imbalance, the interpretation is that sellers are being absorbed by buyers. Since a bid imbalance generally means selling aggression, price action should confirm that by closing below it. When it doesn't, we can infer that buyers are absorbing the sellers. The absorption pattern is sometimes not enough to spot a reversal. We need to confirm it with the initiation pattern right after. The initiation pattern is nothing more than the agreement between imbalances in price. The buying initiation pattern occurs when we see price closing above imbalances in the ask. The interpretation is that the imbalances in the ask indeed represent buying aggression with directional intent. The selling initiation pattern occurs when we see price closing below imbalances in the bid. The interpretation is that the imbalances in the bid indeed represent selling aggression with directional intent. One possible way that prices will reverse is by the combination of absorption and initiation. For example, imagine that we observe price approaching a support line. As price moves toward the line, we see price closing below imbalances in the bid, which agrees with the idea of selling pressure. Once price hits the line, we see an absorption pattern, meaning price closing above bid imbalances. Right after that, the market switches to an initiation pattern. We see price closing above imbalances in the ask in a clear bullish candle. The same logic, of course, applies to a bearish reversal, like you can see here. The important point is that you can use this pattern to help in the confirmation of any type of support and resistance line. It can be standard support and resistance, channels, pitchforks, dynamic lines like moving averages and Bollinger Bands, Fibonacci levels, and so on. Another important information we can find in the footprint is the relationship between price and volume delta. Volume delta is nothing more than the difference between ask and bid volume. As we saw earlier, a bullish candle usually has positive delta, and a bearish candle usually has negative delta. Positive delta means more volume in the ask, which agrees with the idea of buying aggression. Negative delta means more volume in the bid, which agrees with the idea of selling aggression. However, bullish candles don't always have positive delta, and bearish candles don't always have negative delta. This is known as delta divergence. This is important because if all that happened in the ask was related to trading activity directed to adding buying pressure in the market, and all that happened in the bid was related to trading activity directed to adding selling pressure in the market, delta divergence would not exist, but it certainly does. Delta divergence is a sign of absorption, so it complements the patterns we saw earlier. When a bullish candle shows negative delta, it is a sign that buyers are being absorbed. When a bearish candle shows positive delta, it is a sign that sellers are being absorbed. For example, in this image you can see that the candle highlighted is bearish, and it has positive delta. That perfectly complements the fact that we see price close above imbalances in the ask column, which would be a sign of buying initiation. An added detail here is that these are stacked imbalances. Notice how price continues going up afterwards, confirming the notion that sellers got absorbed by more powerful buyers. The footprint shows the volume delta in each candle, but we can also observe it cumulatively over time in what's called cumulative volume delta, or CVD. The advantage here is spotting exhaustion and absorption signals. This works similarly to spotting divergence signals in oscillators, in the sense that we compare the evolution of price extremes with the corresponding extremes in the cumulative volume delta. Let's study the exhaustion and absorption patterns. If price is creating higher highs but the CVD is making lower highs, it means that buyers are losing steam, and price might reverse to the downside soon. That is the buying exhaustion. If price is making lower highs and the CVD is making higher highs, it means that buyers are trying to go up, but sellers are absorbing them. So this movement is not being represented in price action. This is also an indication that price will go down. This is the buying absorption pattern. If price is creating lower lows, but the CVD is making higher lows, it means that sellers are losing steam, and price might reverse to the upside soon. This is the selling exhaustion. If price is making higher lows and the CVD is making lower lows, it means that sellers are trying to go down, but buyers are absorbing them, so this movement is not being represented in price action. This is also an indication that price will go up. This is the selling absorption pattern. We can, of course, use the cumulative volume delta divergence patterns to contextualize what happens with price imbalance and price delta relationships in the footprint. Another important tool of order flow analysis is the volume profile. The volume profile is a variation of Stoudemire's market profile. It simply displays the activity across different price levels over a series of candles, so it's a volume at price tool. Market profile is similar, but it shows the level of activity in each price level based on time instead of volume. Let's learn the main features of the volume profile, and then we'll learn how to use it for market analysis. The volume profile is a horizontal histogram that displays the level of activity in each price level based on volume. The footprint shows the volume action inside the candlestick, but the volume profile shows the volume action across a series of candlesticks. These two tools are actually very similar. Just like in the footprint, in the volume profile we have the value area, which represents 70% of the traded volume, in what's called the POC, or point of control, which is the price level with the largest volume or the peak of the histogram. Some traders choose to use a value area setting of 40% to get more precise readings, since the 70% can be too wide sometimes. In the volume profile, areas of high volume show areas of price acceptance or balance, meaning areas where buyers and sellers relatively agreed about the fair value of the market. Recall that these areas can act as magnets for price. Areas of fair value are also areas of high liquidity. Areas of low volume in the profile show areas of price rejection or imbalance, meaning areas where buyers and sellers disagreed about fair value. Areas of imbalance shown by low volume in the profile have low liquidity. Recall that in areas of low liquidity, price action can travel greater distances with less market activity. Areas of low volume can repel price. All of this, of course, assumes that no new significant information has changed the perception of buyers and sellers. In summary, areas of fair value shown by higher volumes in the profile tend to attract price action. Areas of imbalance given by lower volumes in the profile tend to repel price action. This is very useful to judge the quality of support and resistance levels and the power of supply and demand zones in the chart. There are many details about the volume profile, but for the context of this course, this tool is very useful to identify previous areas of fair value where price might get attracted to in the future and reverse. For example, in this chart you can see that I plotted the volume profile in the upward price movement from A to B. The idea here is to understand where in this trend was the fair value area, which is highlighted by the space between blue lines. Price comes back to this fair value area later on and resumes direction to the upside. From this example, it's clear that the areas of fair value are relative to where we plot the profile. For example, if we change the profile to this upward price movement, the fair value area changes and we end up catching another demand zone. Price does react to this demand zone as well. In summary, different profiles will point to different fair value areas, so it's important to contextualize the volume profile with other tools in order to extract the greatest value